Hi everyone, Adam Bergman, IRA Financial. I'm going to let people take their time to attend. We'll probably start in about 3-4 minutes. We have a big expected turnout for today's webinar. I think it's a very important topic, unrelated business taxable income. And I want to make sure everyone has a chance to register, the ones that have registered to have a chance to listen and watch. So we'll give it a few more minutes. We're going to start soon. It's going to be about 45 minutes to an hour. I'll try to go through the slides in about 45 minutes and then have some time for questions. Okay, we're going to start in about 1 minute. We have over 500 people registered, so we got a maximum capacity for this webinar. I know there's interest in UBTI, unrelated business taxable income, 4-letter word we all need to understand, especially people that are using alternative assets in their retirement account. It's a concept people need to understand because there's potential tax implications that need to be comprehended to make sure the investment makes economic sense for the investor. So I'm going to spend about 45 minutes going through some of the rules, talking about some of the application of the rules, some case law, private letter rulings to see kind of where your transaction may fall and whether it could be subject to these UBTI rules, unrelated business taxable income. And you can then have a better idea, talk with your advisor as to whether the investment makes sense or not based off the application of the rules. Again, Adam Bergman, IRA Financial. I'm going to wait another minute and let people that are running late have a chance. This webinar will be taped and recorded, so whoever registered will receive a link and could watch it or listen to it at a later point at their convenience. So don't worry. This was only open to our clients that pay our annual compliance service fee. So thank you for making that happen. It's very important to make sure you stay abreast of all new rules and developments regarding the self-directed retirement plan. And this is just one of the important services we provide, is to offer webinars and podcast, blogs, videos about important topics that a self-directed IRA investor should know about. So here's just a little bit of information about me, Adam Bergman. I'm a former tax attorney, and I've written 7 books on self-directed retirement plans. I'm passionate about what I do. I love talking about self-directed retirement plans. I had a chance to speak to a number of major publications on various topics. I write for Forbes. This is certainly my area of expertise and what I love to do. And I'm excited to talk about unrelated business taxable income for the next 45 or so minutes. So let's start with some retirement account investment basics. This is probably very basic to most of you, but let's just go through some of the basics. So why do people want to use retirement money to make investments? Number one is deferral, right? When you buy in real estate property, or when you buy stock, or you buy an asset, when you sell it, there's no gain. So long as you're over 59 and a half, the Roth's been open 5 years, you never pay tax on those funds again, ever. No ordinary income, no capital gains, never. So the Roth obviously is some very interesting tax advantages. What are the benefits of using retirement funds to make alternative asset investments? Some of the few are diversification. You can diversify away from just stocks, equities, invest in what you know and trust or understand. Some people just have more trust or faith in hard assets like real estate versus mutual funds or equities, and also the idea of hard assets hedge against inflation. Most IRS-approved investments do not trigger any tax. Okay, the big buckets of categories of income or interest, rental income, capital gains, dividends, royalties. That's what most retirement investors generate from their investments. They're not subject to tax. So that's why most people have never heard of this four-letter word that we're going to talk about, UBTI. So just quickly, prohibited transaction rules. You can't buy life insurance, collectibles with an IRA, and also engage in a prohibited transaction outlined under 4975, which is essentially a self-dealing or conflict of interest transaction. Any IRA transaction that exclusively does not benefit the IRA is not allowed. So if you buy a house and live in it, clearly you're personally benefiting, and that's not permitted because the exclusive benefit is not being derived by the IRA. So let's get into the idea of UBTI, okay? Unrelated business taxable income, unrelated business income tax, also known as unrelated debt finance income if you're using leverage. And essentially, as I mentioned, for 99% of Americans, UBTI is not relevant, okay? And we'll see why. If you're just buying mutual funds, stocks, ETFs through a traditional broker or bank, you're not going to deal with UBTI, okay? Unless you're buying what's called a MLP, Master Limited Partnership, you're not going to have to deal with UBTI. So that's a good thing. If you're investing in alternatives, UBTI could pop up, and that's kind of why it's important that we understand the rules. So there's basically, and just to get to the meat of this, UBTI, unrelated business taxable income, was a concept that was basically built into the tax code in the 1950s. It was there initially to stop businesses like McDonald's from setting up charities and running their business through charities. So before 1970, or so, before IRAs were born, UBTI was really a term that applied to charities. Okay, some 401ks, but mostly charities like the Red Cross. So the idea was they didn't want companies like Ford or McDonald's setting up charities and then just running their business through a charity and never paying tax. So they said, okay, if you're a charity, a tax exempt, like a 501c3, and you engage in active trade or business activities unrelated to your exempt purpose, we're going to tax you like a business. And that's basically was the concept behind the unrelated business taxable income rules. That got expanded to unrelated debt finance income. So if he's leveraged in your investment, Congress felt that you were acting more like a business than an investor, and they were going to apply the same taxation rules. Interesting enough, in the 1980s, there was an exemption that allowed a 401k to use leverage without a tax, and we'll get to that in a minute. But really, before we get into the meat and potatoes of the UBTI, let's talk about the history, and it's important to understand the history. The history was there to stop businesses like McDonald's from setting up charities to run their business through charity and not pay tax. So now that you kind of understand the birth of the UBTI rules, let's talk about how they're triggered. So they're really triggered in three different instances. Okay, one is using margin to buy stock. Margin is like a loan to buy stock in your IRA. It's not very relevant in the self-directed IRA world because if you're buying stock, you're really not using your typical self-directed IRA. You can go to Schwab or E-Trade and buy stock there, probably more cost effectively than you could through a self-directed IRA custodian. And from the margin rules, you just can't personally guarantee the loan. So if you're able to get a non-recourse loan to buy stock, which is known as margin, you could trigger this UBTI. That's number one. Okay. Number two is if you use a non-recourse loan to buy real estate. So if you're an IRA and you use a non-recourse loan to buy real estate, you can trigger a UBTI tax. Now, what's a non-recourse loan? A non-recourse loan is a loan you do not personally guarantee. Why am I saying a non-recourse loan? A non-recourse loan because if you personally guarantee an obligation of your IRA, you trigger the prohibited transaction rules, which is way worse than UBTI because UBTI is just a tax, right? It doesn't invalidate your IRA. It's just a tax. And the highest tax rate is 37%. So it's just a tax. It's not a penalty, and it doesn't disqualify the IRA. Whereas personally guaranteeing the obligation of your IRA does, and that's obviously something you can't do. So just to recap, number one, marginal buy stock triggers UBIT. Number two, if you use a non-recourse loan to buy real estate. So if you have 100 grand in your IRA and the property is 200 grand, and you have to go to a non-disqualified person to borrow that 100,000, bank, a friend, colleague, brother, sister, and you borrow that money and buy the property, that $100,000 of acquisition indebtedness or leverage or non-recourse loan will trigger this UBTI tax. And we'll talk about how it's applied in a few minutes. And then the third category of transactions that can trigger UBIT is if your IRA invests in an active trader business, like a restaurant, through a pass-through entity like an LLC or partnership. So the reason I say pass-through entity is if you buy stock in a corporation like Apple, Google, 99% of all public companies are C corporations, you don't trigger UBIT, right? That's why you've never heard of UBIT. That's why 99% of Americans never heard of UBIT. Why? Because almost all public companies are C corps, and C corp, think of it as a big box. It boxes in the income. The corporation pays the tax, okay? And at that point, the UBIT is then swallowed up by the corporation in the form of corporate taxes, and it doesn't flow through to the shareholder because a C corp is not a flow-through entity. Whereas an LLC or a partnership are flow-through entities for taxation. The entities are tax invisible. They don't pay tax. They file returns. Okay, so a partnership, but there's no tax due because the owners or the members pay tax. So if you have invest in a business like McDonald's or a restaurant, and you do it through an LLC or pass-through entity, you will trigger this UBIT tax. Okay, so let's go through some examples. If you invest in a non-business, like investing in a home, and we'll get to this in a few minutes, what's a business and what's not a business, and you do it through a C corp, clearly you don't have UBIT. If you buy a house and rent it out, even in an LLC or partnership, you probably don't have UBIT. Why? Because buying a home and renting out is likely not a business. Whereas if you invest in a consulting company, a tech company, something that generates income, business income, where there's revenues, there's expenses, there's employees, something that looks and feels like a business, if you do it through a pass-through entity like an LLC or partnership, you could trigger UBIT if there's income of over $1,000. So the big question then is, number one, is there a loan, right? If there's no leverage for real estate, you have no UBTI. And then when you're looking at investment into a fund or a business, the question is it a business? And if so, are you investing through a partnership or an LLC? Okay, so in order to trigger the UBIT, you either need a loan to buy real estate, a loan to buy stock, or you're investing in a business through a pass-through entity like an LLC or partnership. If it's not a business, there's no UBIT. If there's no partnership, you have a C corp, no UBIT. If there's no loan, likely no UBIT if you don't satisfy the loan requirement in the real estate example. So again, it's very important to understand UBIT is only triggered again in three instances: margin to buy stock, loan to buy real estate, and if you invest in an active trader business through a pass-through entity like an LLC or partnership. Okay, if you invest in a C corp, no UBIT. You can stop your application. You don't have to worry about UBIT. If you're buying real estate and there's no loan, there's no UBIT. If you're not investing in a business and there's no loan, there's no UBIT. Okay, so those are the three items to consider. Leverage, you got to look for, is there a loan out there? Is there a business? And is there a pass-through entity? If you have a C corp and you have no pass-through entity, you don't have any UBIT. If you are not investing in a business and there's no loan, there's no UBIT. Okay, so it's really, when I'm looking at a transaction and a client is talking to me about a transaction and getting my thoughts about UBIT, I'm thinking in my head, okay, pass-through entity or C corp. If I hear pass-through, I go to the next step. Is it a business or is it passive? And we'll get to that determination in a bit. If I believe it's not a business because they're just buying a house or just doing a loan to a friend, then I'm not thinking UBIT. But if I hear pass-through entity, I hear business, I hear investing in a factory, investing in a coffee company, I'm thinking, okay, UBIT. I hear pass-through entity, I hear business, I'm thinking UBIT with an IRA 401k. Real estate using a non-recourse loan, or the investment funds buying real estate with a loan, and there's an IRA, I'm thinking UBIT. So let's talk about some of the exceptions, right? Because let's say you are in an example where there is either leverage in real estate or there's a pass-through entity in a business. So now you're kind of potentially in this UBIT world. What does that mean? So we talked about some of the main exceptions under Internal Revenue Code section 512. The big categories: dividends from stock, right? Interest from a loan, annuity income, royalties, right? From trademarks. Make sure it's a clear royalty. It's not working interest in a partnership, but it's a clear royalty. Rental income from real estate, assuming there's no leverage associated with that real estate. And obviously a capital gain. You buy and sell stock, you buy and sell real estate without leverage. Any capital asset, you should be exempted from UBIT. So again, it's important to know that if you do have a real estate asset with leverage, even that rental income becomes subject to UBIT because the loan on that real estate triggers the UBIT. Okay, so let's again just summarize this because it's very important. We sent out an email to all our clients several days ago, and we got hundreds of questions about UBTI or UBIT and about specific examples. So again, just to summarize, in order to trigger UBIT, you need margin to buy stock, non-recourse loan to buy real estate in an IRA. There's an exemption for 401ks, which we'll get to. And your IRA needs to invest in an active trade or business through a pass-through entity. Okay. When I say pass-through entity, I mean LLC or partnership. You're not going to see S Corp investments because IRAs can't own an S Corp. It violates the S Corporation shareholder rules. So if you see an LLC in partnership and you see an IRA and you see a business, a light should go off in your head and you should be thinking UBIT. If you're an IRA investor and you use a leverage by real estate, light should go in your head and think UBIT. Okay, and at that point you can talk to an accountant or to your tax advisor and kind of get the potential impact this UBIT could have on your investment. But my interest is to really set light bulbs up in your head, give you kind of tidbits of information, some warning signs that you need to look at to make sure that you're on the right track and you can ask your tax advisor the right questions. Again, last time I'm going to reinforce this: margin to buy stock, non-recourse loan to buy real estate in an IRA, and invest in an active trade or business through a pass-through partnership or LLC. If you're not doing that, you're not going to have a UBIT. So if you buy stock in a C Corp, if you invest in a C Corp business, if you buy real estate without leverage and it's not a business, you're not going to have to deal with UBIT. So let's talk about what types of transactions could trigger UBIT. And I kind of went through some of these examples already. Obviously, if you're in business income through an LLC, you invest in a store, a manufacturing business, anything that's a business, okay? And it has to be operated through an LLC or partnership, you're going to have UBIT. Again, use an IRA, get a loan from a non-disqualified person, a non-lineal descendant, buy real estate. 514 is going to trigger this UBIT tax. Real estate, and I know real estate's a very hot investment for many self-directed IRA clients. There's actually an article in today's Wall Street Journal about how house flipping is kind of back to where it was pre-2008. So it's definitely a hot investment area that a lot of real estate investors are looking at. And we'll talk about flipping, whether flipping is a business or not, and whether that can trigger UBIT. But if you're just buying a house, you have $100,000 in your IRA, you buy the house for $80,000 and you rent it out to Joe Smith, the rental income is not going to be subject to UBIT, right? If you sell that house, you're not going to be subject to UBIT. Why? No loan and you're not in a business. Okay, so let's talk about flipping real estate and UBTI. And again, if people have questions, feel free to send them in, and I will allocate some time to go through some of these questions. If I don't have time to go through them, I will get to them either a different webinar or I will draft responses and send them out. But please, if you have questions, don't hesitate. So flipping real estate, right? If you're doing real estate, how can you trigger UBIT? Two ways. Okay, if you use leverage, right? And in IRA, you're going to have UBIT right away. If it's a 401k, we'll talk about the exemption. Or your flipping turns into a business. So this is probably the most popular question I get from investors, real estate, is I'm going to flip 2 or 3 homes potentially in a year. Is that a business? Unfortunately, I can't answer that. Why? Because the IRS can't even answer that. It's a fact and circumstance test. We'll go through some case law now that kind of gives you an idea where the courts are on this, but a lot of it is going to be based off what the IRS agent feels and ultimately what maybe a court feels, or if you get a private letter ruling, what the IRS feels. But there's some facts and circumstances that we're going to look at that can give you a better idea of whether your transaction could potentially trigger UBIT. I think it's pretty clear to say if you buy 1 or 2 homes and flip them, you're not going to have UBIT. It's going to be hard for anyone to argue. 1 or 2 homes in a year, you're in the business of flipping homes, especially in your retirement account. Stocks is even more passive. So I get this question a lot. Well, I buy 50, 60 shares of stocks or mutual funds or ETFs in a year. I sell them, I buy them, I'm pretty active. Does that trigger UBIT? No. Stocks are super passive. You'd have to be considered a day trader to trigger UBTI to be in the stock business, trading business. So it'd be very hard to get to rise to that level. Real estate is a little more active than stocks, more active than trading notes, for example. So unlike stocks, 5, 10 real estate transactions in a year could trigger a business where if you buy and sell 5 or so stocks in a year, you're likely not going to be in the business world. So let's look at this case. It's a 1952 case, Malden v. Commissioner. It's actually one of the more important cases in this area. And the court in Malden basically said that there's no fixed formula or rule of thumb for determining whether a property sold by a taxpayer was held by him for primary sale for customers in the ordinary course of trade or business or not. So Malden was basically saying, how do we determine if something's a business or not? And the court's saying, well, there's not one factor. You got to look at a whole slew of factors. And the court set forth a number of factors, okay, to look at. And now Adam, which is another important case, it's 1974 tax court case, and it actually analyzed some factors that a taxpayer should look at to determine whether their activity rises to the level of a trade or business. Number 1 is frequency. Okay, obviously the more flips you do, the greater chance you're in the business world, right? 1 versus 50, okay? Clearly that's a wide spectrum, but even 1 versus 7. 7, it's going to be easier for the IRS to argue you're in a business versus 1. Also purpose, why was the asset acquired? In the IRA case, it's pretty simple. It was clearly for investment purposes. But if your intent and purpose was for your IRA to be in business for whatever reason, that could be a problem. And then there's some private letter rulings that I wanted to mention, 1 or 2 of them, that kind of gives some clarity as to where the IRS is kind of looking when it comes to business or not. So in this 92 PLR, the IRS issued a favorable ruling to an organization, a charity, that planned to sell land in up to 15 sales spread over a 5 to 10 year period. And the court, the IRS basically said, the market conditions dictated this. It's not a business. The reason so many sales had to occur was just the way it happened from a market standpoint. There's a 1990 PLR, again from a charity, where the exempt org was engaged in selling 45 of 68 lots. And the sales were deemed to meet the exception for UBTI and not subject to UBTI, even though the sales were significant. The org first tried to sell the property in 1 block and couldn't do it, and that was the reason they had to subdivide. So let's look at some other factors to determine whether a flipping transaction could trigger UBTI. So flipping is definitely more of a gray area, where if you invest in a restaurant, it's not gray. You're investing in a business, okay? If you're investing in a manufacturing, a factory, a consulting company, a coffee company, a tech company, a software company, it's pretty clear. Real estate is gray because, as we know, there's millions of Americans that buy real estate passively, right? They file a Schedule E, they just hold it to collect rental income, but they have a full-time job. Maybe they're a lawyer, a doctor, accountant, but the rental income is just very passive. And we also know there's lots of people that are full-time real estate investors, whether they're developers, real estate agents, general contractors, or just plain flippers. That's their business, right? They file their Schedule C, or they have a C or S corp. They earn a salary. That's their business. So I say real estate's great because depending on the facts and circumstances, as these cases and PLRs clearly designate, you could be in a passive situation where you're not going to trigger UBIT, or you can be in an active situation where you may trigger UBIT. So I think it's helpful to kind of look at some of these cases and examples, kind of see where the IRS falls on this. So obviously, the more you do to improve it, again, more proof that it's a business. So if you buy a house, put a little bit of money in, hire a contractor to knock a wall down, paint the fence, do some landscaping, yeah, that's not going to be as significant as building the house from scratch, right? If you're just buy a piece of land and build 5 homes on it, yeah, that probably looks like you're a real estate developer and you're probably in an active trader business investment. If you buy a house and you paint the fence, or you have a general contractor, do some handiwork, it's not likely going to be significant improvements. So let's look at this PLR. An organization proposed to sell a parcel of undeveloped raw land. The fact that the land had remained undeveloped was significant in determining the gains would not constitute UBTI. The next one is an 85 PLR. Property consisted of both developed and undeveloped. Developed lands included residential land improved with single-family dwellings. However, all the improvements were constructed by unrelated third parties. The absence of development activity by the org demonstrated that it was not holding property for sale to customers. And that's kind of the most important line of analysis. If you are selling inventory, property for the sale of customers, in the ordinary course of business, like if you are Walmart selling soap, or you are a supermarket selling cookies, or you're a coffee store selling coffee, or a furniture store selling desks or sofas, clearly you're in business. You're selling inventory in the ordinary course of your business. If you're in real estate and you buy a house and fix the fence up to sell it, it's hard to argue that's inventory. But if you buy a piece of land and build 15 homes on it, that looks a little bit more like inventory to me. So again, the extent of the improvement is important. The less you do, the harder it is, I think, to show you're in business. And again, these are just some more cases to look at, some more examples about whether you're in an active trader business or not. And again, why is this important? Because if your IRA invests in a passive activity, you're not going to trigger UBIT so long as there's no loan, right? If you buy real estate and it's a business, you're investing in a real estate fund that operates business, 50, 60, 70 homes that they manage, or 15 hotels or apartment buildings, with or without leverage. That could be a business, assuming the real estate has leverage. And clearly, if you're investing in an IRA, you're going to have UBTI. But even without the leverage, you have to look at whether the real estate activities rise to the level of trader business. Again, it's a gray area. The more activity you see, the bigger the numbers are, the better chance I think the IRS has in arguing it's a business. Clearly, one home is not as significant as building 20 homes. If you buy an apartment building, it still can be passive if there's no leverage, right? Because it's all rental income. But if you're building an apartment building, that could look more like a business. Or if you own 15 apartments in that apartment building, that could look more like a business. So let's look at some of the main factors to determine whether a flipping transaction can trigger UBIT. Obviously, the proximity of the sale to purchase, right? If you buy the house today and sell it tomorrow, if you do that once, probably not a problem. If you do it 15 times in a year, probably a business, okay? In this PLR, it's a 1995 PLR. The school received land by bequest and held it for a significant period of time, and the IRS did not oppose UBTI in the sale of the land. Again, we looked at Adam case. It's an important tax court case. It said no single factor is controlling. So again, just to highlight that set of analysis, it's not one factor. It's not frequency. It's not scope of improvement. It's not intent. It's kind of everything together. And that's why I say it's a gray area, because it's very facts and circumstances intensive. I may look at it as a business. You may not. The IRS may or may not. One agent may or may not. But it's important to be conservative. It's important to think about the application of the UBTI tax, which can trigger a 37% tax, which is significant. It could change a very tax-friendly investment into a not tax-efficient investment, and it may change your thinking in terms of whether doing this in an IRA, and maybe you want to talk to a tax advisor, say, hey, maybe I don't want to do it in an IRA, maybe I want to buy this property personally because I'm going to use leverage and I'll get tax deductions on the use of the loan. So UBTI is very important. That's why I call it a four-letter word, because it could have some negative connotations. It rarely has positive connotations, because it's generally, the beauty of using an IRA is there's no tax when you buy and sell an asset. But the UBTI could trigger this tax, and it's not a capital gains tax, which is 15% at its minimum. It can go as high as 37%. So it's pretty significant. It's higher than the corporate tax rates, even, because it follows the trust tax rates. So obviously less is always better, 1 home versus 10. Is this an investment versus inventory, right? If you're investing in a store that sells t-shirts, looks like inventory, whereas if you're buying a house, it's hard to argue 1 home's inventory. Obviously the more space in between flipping transactions help. The less work you do, the better. What your intent is. If you're a doctor and you're going to flip a couple homes, your intent clearly is not to be in the real estate business. However, if you're a real estate developer using personal funds and you flip 3-4 homes, that's one factor the IRS could look at to see, hey, this is kind of akin to your personal business. Maybe we're going to look at this as a business. So again, like the Adam case said, it's not one particular factor. You got to kind of look at the whole picture. It's all the bricks in the home, they all add up to whether it's a business or not. Obviously, you want to speak to your tax advisor. You want to be quite conservative because of the heavy burden of triggering the UBTI tax. But again, UBTI is triggered in only 3 instances. If you don't satisfy these 3 instances, you really have nothing to worry about from the UBTI standpoint. Marginal by stock, non-recourse loan to buy real estate in an IRA, and investment in an active trader business through a pass-through entity like an LLC or partnership. So if you have no real estate, no leverage, no business, no pass-through entity, you have nothing to worry about. If you're generating capital gains, interest, dividends, royalties, rental income, no business, no loan, you got nothing to worry about. If you're investing in an active business through a C Corp, nothing to worry about. If you're investing in real estate with a leverage through a C Corp, nothing to worry about. It's only those 3 instances: margin to buy stock, non-recourse loan real estate in an IRA, and investment in an active trader business like a store, restaurant, through an LLC or other pass-through entity. C Corp will block it. And we will get to the blocker concept in a minute. So what's UDFI? A lot of people say, well, I'm going to trigger UDFI, unrelated debt finance income, and not UBTI. Well, it's actually a 4-letter word. It's the same thing. UDFI is found under Section 514 of the tax code. It triggers the UBTI tax. So it's all part of the same family. Whether you call it UBTI, UDFI, it doesn't matter. It's the same tax. The one interesting thing about UDFI is that there's an exemption for 401k plans. Under 514C9 of the code, if you're a 401k and use non-recourse loan, again, it has to be non-recourse. If it's recourse, meaning you personally guarantee the loan like a mortgage, you've done something far worse than triggering UBTI. You've triggered a prohibited transaction. You got a lot more problems than paying tax. So it has to be a non-recourse loan. And if you're able to get a non-recourse loan, and there are a number of lenders throughout the country, whether it's big banks, small banks, or specialized lenders, generally they want at least 35% down. Why? Because they're taking more risk. You can't personally guarantee it. The only collateral they have is the underlying asset. Right? There's no personal guarantee. So they're generally going to want anywhere from 35% up in cash. So if you want to buy a property for 500 grand, putting 20 grand in your IRA down is probably not going to cut it. You're probably going to need to come up with at least 35% down. And then they're going to look at the asset. They're going to look at the income producing or not. They're going to look what state you're buying it. They're going to look at a lot of different factors to determine whether they're going to lend you the money. Now, you don't have to go to a bank. You can go to any non-disqualified person, a brother, sister, aunt, uncle, cousin, friend, neighbor. It just cannot be a disqualified person. Who's a disqualified person? 4975E2 says a disqualified person is you personally, as the IRA owner and the fiduciary, or any of your lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, any entities controlled by such persons. So you can get a loan from a bank, financial institution, or any non-disqualified person. Loan has to be non-recourse. If you're using an IRA to buy the real estate and this loan is used for real estate acquisition purposes, and there's more than $1,000 of net income, you're going to trigger UBIT. Okay, and I'm going to talk about some examples about how you calculate it. But there's an important exemption again for 401ks. If you use a 401k, not an IRA, but a 401k to buy real estate and you get a non-recourse loan, 514c9 will exempt it. And it's hard. I actually researched the legislative history on this. It's not clear as to why 401ks got the exemption. The exemption kicked in the early 80s. And based off the legislative history, what I gathered is that they wanted 401k plans to have more diversification for whatever reason. They wanted plan participants, I guess, to have that ability, and the plan trustees to allow them to do that. Again, there's not a concrete reason why 401ks got the exemption. Maybe at some point IRAs will get it as well. I don't know. It doesn't seem like there's a good reason why one has an exemption and one doesn't. Again, these rules, UBTI, UDFI, they initially were not targeting retirement accounts, right? ERISA was only created in the 70s. These rules were back in the 50s. So this was targeting charities, right? It was targeting businesses like McDonald's that were going to set up charities, run their business through a charity, and never pay tax again. That's what these rules were aimed at stopping. So retirement accounts kind of got mixed in by mistake, so to speak, because they're a 501 trust, like a charity. They're taxed the same way, so to speak, or they're treated similarly. An IRA is a trust, right? There's an IRA trustee, which is the custodian. 401k is a trust. That's why there's a trustee of the plan. So even though you don't consider them trusts, they actually are. And that's why when the UBTI is triggered, there's the trust tax rates apply. So just remember, when you're thinking about whether you're going to have UDFI, it's only triggered in an IRA, real estate, and a 401 and a non-recourse loan. So you need three players. You need an IRA, you need real estate, and you need a non-recourse loan. If there's a C corp there, it's going to block it. Okay, so you need IRA, non-recourse loan, real estate, and it has to be either directly held through the IRA or a flow-through entity. C corps always block it. If you see a C corp investment, you don't have to ever worry about UBIT, whether it's real estate, whether it's leverage, loan, non-loan, doesn't matter. And that's why when you buy Apple stock or IBM or Google or Ford or Tesla or any of the 99% of the public companies, there's only several partnerships that are publicly traded. One's a private equity fund. Very few, 99.something% are C corps. So that's why they block the UBIT, and that's why most Americans never heard of UBIT. It's only when you get into the alternative world, like real estate or even master limited partnerships, private equity, hedge funds, whether real estate or not, that you have to worry about UBIT, or unrelated business taxable income. So how do you calculate UDFI? So there's actually a form called the 990T, which is actually due April 15th. It's due March 15th for non-IRAs, but April 15th for IRAs or 401ks. And you can file an extension. And this is where you would file with the IRS and disclose the UBTI. So if you see the first line, it says name of organization, that's where you'd put in your IRA, and you'd get a tax ID number for your IRA. And then there'd be a schedule for unrelated debt finance income. It's actually it's somewhat complicated. Not every CPA has expertise in it. Why? Because this form is really used for charities and retirement accounts, and not every accountant has that client base or the expertise. If that's just something to keep in mind. It's a form that needs to be filed, and tax needs to be paid. And the tax rate, as we'll see, is somewhat steep. This is the UBTI tax rate. It follows the trust tax rates. You see, once you have around 15,000 of that income, you got 37% tax. So it's kind of heavy, the tax rate. It follows the trust tax rates. It's not a capital gains tax rate. So that's why it's important to understand the application of UBTI. But before we get into that, how do you calculate it? So basically, the IRS is saying, listen, if you got to pay tax, we're going to give you the benefit of a pro rata share of deductions. So if you put $50,000 in cash, in IRA cash in, and you borrow $50,000 from a non-disqualified person, you have a debt to equity ratio of 50-50. So the IRS is going to give you 50% pro rata share of any depreciation or related expenses, which will reduce your UBTI tax. So that's when you're going to need to work with an accountant that can help run those numbers. And that makes sense, right? If you're going to pay tax, the IRS is going to treat you like a taxpayer and give you the ability to take into account your share of deductions like depreciation. So for a lot of investment, especially in real estate, the first few years, there's not a lot of UBTI because depreciation or other expenses will reduce the net taxable income. And another nice thing is there's NOLs are allowed, net operating losses. So for real estate investors, the first few years, a lot of real estate investors will generate NOLs because of all the expenses allocated to investment. You don't have to file a 990T to capture the NOLs. It says it clearly in the instructions. So I get this question a lot. I have an NOL. What do I do? The question, you actually don't have to file the 990T, but when you actually do have to file it because you have more than $1,000 of income, that's when you'll have to refer to that NOL, and that could trigger an audit if the IRS wants to contest that or discuss that further. They can look at that, but that's what you do. You would include that NOL from past years on the 990T. So make sure if it's only again triggered if you have UBTI. So again, margin to buy stock, non-recourse loan for real estate and an IRA, or investment in an active trader business through a pass-through entity like an LLC. You need more than a net of $1,000. So if you only have net $50, $100, $999, you don't have to file the 990T. $1,000 plus, and you triggered UBIT, you have to file it. It's due April 15th. And again, you get your pro rata share of expenses. There's net operating losses that can further reduce it. There's Schedule E, that's where you're going to have to disclose the UDFI. The tax rate, as we saw, can go as high as 37%. So it's pretty steep. But how do you avoid it, right? So we talked about how it works, the history behind it, how you trigger it, the application, talked about some of the private letter rulings, the case law, about whether it's a business or not, whether it could trigger the UBIT in the business setting through a pass-through entity. Remember, if it's a C Corp, there's no issue. You don't have to worry about leverage. You don't have to worry about business or no business because the C Corp blocks it. So how do you block or avoid UBTI? So the first way is if you're using a non-recourse loan to buy real estate, the first way clearly is try to get into a 401k plan. So how do you get into a 401k? Well, you need to have a business to adopt a 401k. So if you are retired or on Social Security, or you have a full-time job at Google and you have no self-employment income, you're not going to be able to have a 401k. So that option may be closed to you. But if you do have some self-employment income, maybe you drive for Uber, maybe you sell stuff on eBay, maybe you are Santa Claus for Christmas, anything that you tutor kids in math, anything that generates net Schedule C income, you technically could adopt a solo 401k. Okay, that may be one vehicle. If you are using a leverage, a non-recourse loan to buy real estate, using the 401k could help you avoid the 37% tax. So that's the first option, is try to get into a 401k if you're going to be using a non-recourse loan to buy real estate. If you're going to invest in an active trader business like a restaurant, IRA 401k, same application. There's no exceptions. So that won't help you. But if you're going to use non-recourse loan to buy real estate, using a 401k could be very helpful because you could block the UBTI from applying. Again, you need to get into a 401k. You got to be eligible. If you work at Google, they're probably not going to let you buy real estate in their plan. Why? There's all kinds of fiduciary issues, higher sense of risk to the trustees of the plan, and they're just not going to let you do alternative assets. Some smaller businesses will, but 99% of 401ks will not let you do alternative assets. So if you work at a larger company, you may not have that option, so then the solo K may be your only option if you are eligible. Second way to avoid it is a blocker. Okay, so prior to the Tax Cuts and Jobs Act of 2017, something that President Trump orchestrated, the blocker C Corp didn't have a lot of value. Why? Because the highest C Corp tax rate was 35%. Okay, and we know the trust tax rate at that point was actually 39%. So there wasn't a huge difference, right? 4%. The only difference was if you had less than $50,000 of income, the C Corp tax rates were actually lower, right? So you were able to have some play. If you generated less than $50,000 of income, the C Corp tax rates were lower. and there was some play in between this trust tax rates of 39% and the 15% or so corporate tax rate for under $50,000 of income. But once you had over 50%, you were in the 50,000, you were in the 35% tax rate, so it wasn't a big play. What happened? The Tax Act reduced the corporate tax rate from 35 to 21%, and that opened the window for a lot of retirement investors to use a C Corp blocker to make investments. Whether there's leverage used, whether it's an active trader business like in a restaurant, or whether you're investing in a hedge fund or a private equity fund that would trigger UBIT, the blocker became pretty popular. Before the Trump tax rate, again, the C Corp blocker wasn't really used for retirement investors. It was used for foreign investors into hedge funds and private equity funds. They would set up a Cayman C Corp blocker to do the foreign investment into a U.S. company because Cayman had a 0% tax rate. But for the average self-directed IRA investor, it wasn't very beneficial, didn't have a lot of value unless there was less than $50,000 of income. There was some opportunity, but otherwise $50,000 or more income, you're saving at most 4%. It really wasn't that helpful. And then you have to file a corporation tax return, federal and also potentially state corporate tax return and tax. Just didn't make a lot of sense. But now some investors have looked at the C Corp blocker because of the 21% tax. You have a discrepancy of corporation of 21 versus old rates of 35, and now the UBTI rate's actually 37%. So 21 versus 37, 16%. Even if you add a state tax rate, in some cases it makes sense. So blockers have become more popular for self-directed investors who are looking to use leverage or invest in an active trader business. But it's something you just got to run the numbers, because one thing to consider is the 21% tax applies to all the income. So if you are using 50,000 IRA money, 50,000 debt, 50-50 debt to equity, your UBTI tax, 37%, is only on 50% of the net income, whereas that 21% will be on 100%. So you got to run the numbers, right? You got to kind of work with a tax advisor, or if you're comfortable, do it yourself, but you got to run the numbers to make sure the 21% actually is going to save you on taxes, because it may not, depending on how much debt. Clearly, the more debt you have, or the higher your ownership in the active trader businesses, maybe the 21% has more value. Third way to block UBIT is a loan, right? For some people, it's an opportunity. Other people, no. If you want to invest in Google, buying stock's probably more valuable than buying a note. Why? A note or a loan or a debt is stated rate of return. You get extra interest and your money back. Equity, you have upside, right? That's the difference between debt and equity. Debt is interest, stated rate of return. Equity is obviously more upside, more downside. There's no stated rate of return. Okay, so if you have an ability to convert and go debt, and you're comfortable with the returns, then an interest-bearing investment will not trigger UBIT. It will exempt you from UBIT under Section 512. Whereas if you want upside in the investment, it's a startup, and you think there's a home run there, the equity investment obviously makes more sense than getting 8 or 10% return. If you do a convertible note, then once you convert to equity, then the UBIT is triggered. Okay, so that's just something to consider. 3 different ways, again: blockers, loan, or move from an IRA to 401k for real estate. That's really the only ways to block UBIT. I wish there were more ways, but that's it. So again, UBIT could be one way that you can turn a cost-effective investment into a very unfriendly tax investment. It's a 4-letter word, just like I tell my kids certain words are 4-letter words, don't use them in school. This could cause a lot of tax headaches for you from an investment standpoint. It could turn a really tax efficient, really interesting, creative investment into something that's a tax nightmare. So be cautious of it. There should be light bulbs that go off in your head when you see real estate and leverage, when you see an active trader business and partnership. Those questions and those issues should be popping up in your head. I got about 12 minutes left for questions. I got a lot of questions, so let me try to get to a few of them because the questions, they look really interesting. Okay, let me go to them right now. So I got a question here. I've used some of my IRL funds to buy mineral rights. There has not been any lease yet on these minerals, but hopefully there'll be soon. I receive a lease bonus. And if it was drilled, I'll be receiving royalty income. Okay, so when it comes to mineral rights, these are some complex issues. There's some private letter rulings on this stuff. The nuts and bolts is this. If it's straight up royalty income, you won't have UBIT, okay? But if you're getting a working interest in the partnership, you're going to have UBIT. And a lot of these investments are structured where there's working interest, meaning you get the upside of ownership. Where there's additional contribution requirements, you have K1s, there's partnership issues, you're going to be treated as a member and you're going to have UBIT. If you're just getting a royalty, you won't have UBIT. The best way is to look at your K1, talk to the promoter of the investment, see what they are treating this. But it's hard to make just a generalization. But from my experience, a lot of these mineral investments could trigger UBIT because you get a working interest. One thing I just want to talk about is this. A lot of times I get this question, well, I don't know if there's UBIT. How can I know? I'm investing in an investment fund. Okay, there's hundreds and hundreds of investors. I get a K1. I don't see any notification of UBTI. And it's a good question. Some investment funds are not as sophisticated as others, and even though they know there's an IRA investor or 401k investor because they can see it potentially from the subscription agreement or the partnership agreement the IRA custodian signed, they just aren't sophisticated enough to provide you this information. This would be on a K1, and usually there's a box on the bottom of the K1, I believe it's new box 25, and there'll be a code for other income, and that's where that code should show the UBTI income. It doesn't always show it there. Sometimes you might see it as business income. If you get a K1 and you see business income, you're going to have to pay UBTI tax. The problem is sometimes the K1s aren't sent till after April 15th, or you don't get the K1, it goes to the custodian, you may not see it for a while. What happens? That's some of the issues that occur. That's when you want to before you make the investment, you want to talk to the investment promoter or the general partner and make them aware that, hey, I'm investing retirement money. There could be UBIT. If there is, how am I going to know what the UBTI tax is? I need to be able to file the 990T. I'm going to need information. Without information, I can't satisfy my filing obligation with my IRA. So those are some of the questions you need to ask. Next question. My single member LLC owned by my IRA owns a convertible note which earns interest at 15%. Okay, good. The note is a loan to an active business. Good. Which is a C corp. Okay, great. It is my understanding that my pastor LLC is not required to file a 990T. Right. So it's a great question. So you have a C corp. So if you buy Google debt like Tesla bonds, I think I own Tesla bonds, right, in my retirement account. There's no UBTI. Why? Tesla's a corporation. Okay. Plus, even if it wasn't a corporation, all I'm getting is interest back. So interest is exempt from UBTI under Section 512. So yeah, you have no UBTI there. Okay, this person asked, on a sale of real estate, if the non-recourse loan is paid off 12 months in advance of the sale. Okay, thank you, Linda, who asked this question. I should have mentioned this. If you sell real estate and you had a loan on it, okay, so let's say you put $50,000 cash in it, you borrowed $50,000 on a non-recourse loan from a non-disqualified person in 1999, okay? Now it's 2019, you paid off this loan in 2016, and now you sell the property. Do you have UBIT? No, okay? The rules under 514 state that if you paid off that loan 12 months prior to sale, the use of leverage will be ignored and there'll be no UBIT. So thank you, Linda. That was a great question. I should have mentioned that earlier. If you have real estate and there's acquisition indebtedness, but you've paid that loan off 12 months prior, UBIT will be erased. Thank you. Next question. Bought one single family home for rent with a small loan from a non-disqualified person, not a business, no UBTI. So let's talk about this. If you bought a single family home, okay, you rented it out, but you have a loan, right? So it's real estate acquisition, indebtedness from a non-disqualified person, 514 will apply. If you did it in an IRA, you're going to have UBIT as long as you have more than $1,000 of net income. So you get to take into account your depreciation, other expenses, but you could have UBIT. If you did this in a 401k, there's no UBIT. okay, under 514c9. So yeah, you are generating rent, but that use of the loan under 514 is going to trigger the UBIT. So that's something you need to think about and run the numbers to make sure you actually have UBIT. If you're not sure, file an extension on the 990T. Next question. If IRA invests in a pass-through LLC and there's a sharing agreement with other partners, the asset is a website management agreement for AB education website. This qualifies, it looks like a business to me. If you are invested in an LLC that has some website management, the word management tells me it looks like a business, you probably have UBIT here. Without knowing all the facts, just based off some of the terminology you're using, that looks like more like a business than investing in a investment fund that's just buying and selling stocks or real estate or doing passive investments. I flip raw land. I have a business partner that does this as well. I give a loan from IRA LLC for a purchase. Could that be UBIT since we both have separate business and buy and sell land? Probably not. If your IRA is just lending someone money, assuming that person is not a disqualified person and he's not or she is not a disqualified person under 4975E2, if you just lend someone money, that's not a prohibited transaction. It's not also a transaction that would trigger UBITs because all you're getting back is interest, right? So you can do a bunch of these loans because loans are passive, just like buying and selling stock. So I don't think you have an issue there. Okay, next question. I'm using my IRA to invest in notes with a friend who uses the money for real estate, buying, selling, rehabbing. I don't really know what they do with it, but they're 2-year notes. So again, you have a note's a loan, right? So just like I lend money to Tesla, I buy notes from Tesla, debt. I don't know what Tesla does with it. I assume they're building cars, but I don't know, maybe Elon Musk is doing something else. Maybe he's building spaceships. That's not the issue. The issue is I'm getting interest back, so it's not going to be subject to UBIT. What if you have a full-time? What if you are a full-time real estate broker? Well, if you're a full-time real estate broker, you can set up a solo 401k, assuming you're an independent contractor. From a UBTI standpoint, we know from a prohibited transaction standpoint, you can't provide any services. You can't be the real estate agent. So if you're a real estate agent but buy and sell real estate, again, it's going to be based off facts and circumstances. If you're doing 15 homes, could be a business. If you're doing 1 or 2, probably not. You're going to have to look at all those factors, like the Adams case. Malden says no particular fact is prevalent. You just have to kind of look at the overall situation, facts and circumstances, look at intent, frequency, level of improvements, things like that. But a real estate broker could be a factor the IRS could look at versus someone who's a doctor because you're closer to the real estate world. But again, it's going to be the activities that matter. I got a couple more minutes. Can you cover the math on the UBTI tax? Well, I need a whole hour for that. So again, the hypothetical example I give is you put in $50,000 in your IRA, $50,000 debt, non-recourse debt from a non-disqualified person. You buy a house for $100 grand, 50-50 debt to equity. You generate $10,000 of net rental income after depreciation and expenses. 50% of that, so $5,000, 50% of the 10,000 would be subject to the UBTI tax. We know 5,000 is more than 1,000. You got to follow the 990T, and then you just got to run the numbers to how much tax you owe, and you have to follow the 990T, file it by April 15th, pay the tax for your IRA. To the asset sharing agreement question, monthly revenue only roughly $1,000. Well, if monthly revenue, that's $12,000 annual, so that's more than 1,000. You'd have to file a UBTI tax return, assuming their expenses don't eat up all the profit or the revenues. What if you're investing with a partner who does not have a business flipping houses, but you are functioning as a private lender to do 1-2 flips? Again, if you're a lender and you're just getting interest, you have no UBIT. Is buying one single apartment building in an IRA 401k considered a business? Good question. Again, facts and circumstances. If you are simply buying the building, have a outside party doing all the improvements or any of the management, you're probably not in business. But you could be, right? Depending on what you're doing, what your intent is, the improvements, things like that. Fact and circumstances. I think if you can show you have a third party doing all the management, you're clearly just a passive investor. Rent is just flowing into your IRA. You're not doing anything more than that. probably not a business, but you probably need more facts. But generally, one single apartment building in your IRA is not a business. Do I need to put home insurance in my LLC's name? Yes, because the LLC owns the property, the insurance will be in the name of the owner. I've been buying real estate for my 401k with leverage. You're stating I'll be under the law of UBTI. No, if you use a 401k to buy real estate, you're exempted because you're using a 401k to buy real estate. The non-recourse loans through the 401k, 514c9 will exempt for you from the UBTI tax on the leverage. Now, again, if your real estate activities rise to a trade or business, meaning you've bought and sold 75 homes this year, you may get hit with UBTI, even though you are exempted on the leverage feature. But generally, if your real estate activities haven't risen to a trade or business level, and all you have is a non-recourse loan, the 514c9 will exempt you, no UBTI. When investing in a business via pass-through entity, LLC, if the IRA is not involved with selling goods or performing services on behalf of the LLC, would UBTI still be triggered? Yes, the IRA is never involved in selling goods, right? If I invest in Joe's coffee restaurant, my IRA is not making the coffee; it's just an investor. But the business activity will trigger the UBIT. So yes, if you invest your IRA in an active business like a coffee shop, and there's more than $1,000 in net income allocated to your IRA, you have UBTI income. Of course, your IRA is not going to be involved. It can't be involved. It's not a person, right? It's just a retirement account. If I have an NOL, should I file the loss recorder for future years? No. The instructions, you can read it under 990 instructions. Just to put an edit fine for the word NOL, you'll see it says do not. It clearly says do not file if you have an NOL. You hold it and reserve it and file it when you have income. I own land in the Caribbean in a single member IRA owned with my stepson as manager. I plan to build an investment home on the land to rent it out. I'll always be an investment vehicle. In your opinion, will I pay UBTI? Probably not. Again, one home on a piece of land is not a business, right? Then basically everyone who ever invested in any real estate investment in an IRA would be subject to UBTI. That's not the intent. So I don't think you have an issue with that. Is there any information on UBTI that you can send me? Yeah, there's tons on our website. You'll get a copy of this PowerPoint. You'll get a video recording and tape recording of this. There's tons. If you Google or go on our website, search UBTI in the search function or Unrelated Business Taxable or UDFI. There's tons of info. I've written probably 7 articles on Forbes on this. You can check out on our website the Forbes icon, and you'll get all the articles. There's stuff on go to our YouTube channel, subscribe. There's videos every week that are relevant. There's probably 10 videos on UBTI. So yeah, tons of info. This is something that we're certainly well versed in. I've written every book I've written has a section on UBTI. So there's tons of info. Adam, you mentioned a Cayman blocker. Would you please talk more about that? I spoke with an offshore company, information service, and they were directing me back to USA CPA, but the issue be the tax treatment of the Cayman company. So I'm not here giving people tax advice or acting in a capacity as a lawyer or anything, but generally the whole idea of a foreign blocker is you set up a foreign blocker in Cayman, you don't pay any, Cayman doesn't have any corporate tax. And it's usually used by foreign investors, not IRAs. It's usually used for foreign investors who don't pay U.S. tax anyways, and they don't want to be subject to U.S. tax, so they set up a foreign blocker and invest in the U.S. Investment. You have to watch out about U.S. withholding tax. If there's no treaty, there could be a 30% withholding tax on any remunerations back to the Cayman Corp. So definitely hire a lawyer. You need a good lawyer that can help you. I invested into an LLC that invests in a multifamily property. I'm the equity investor. I own a fraction and receive a K1. I invested via solo K. Is this exempt because of real estate or subject to UBTI? Good question. So you'll have to look at the K1 to see what they're treating the income. If it's under the business income category, you could be subject to UBTI. If it's under capital gains or other income, maybe not. They probably aren't listing it UBTI income. If there's leverage, obviously you're exempted, but assuming there's no leverage, or even if there is leverage, if the income is coming as business income and not dividends, interest, royalties, rental income, capital gains, there could be a UBTI issue because that means you're investing in a business, not an investment vehicle. or a passive investment. Convertible notes, any strategies to extend convertible notes indefinitely? Yeah, don't convert it. That's one way to extend it, just never convert it. But once you convert it, you got equity, then you can look at a C Corp blocker. But the good thing when you convert, if there's then a capital gain transaction, so if you go from a note and then convert to equity, and the LLC ends up selling to a buyer, and you're getting capital gains treatment, you'll be okay. But if you convert and you're getting business income annually, you're going to have UBTI. So again, the UBTI isn't triggered on a capital gain sale. So if you do an equity, let's say you invest in a startup, convertible note, a year before or 6 months before a sale, you convert to equity. There's not a lot of net income anyways, and some company comes and buys all the membership interest. There'll be a capital gain. There won't be any UBTI, assuming there's no leverage. But if there's leverage and it's a pass-through, you'll have UBTI, even if it's not real estate acquisition indebtedness. There's still leverage. But if there's no leverage and it's just a capital gain sale, and there's no business income because it's just a capital gain sale, you shouldn't have a UBTI. Well, I got a lot more questions. I'm going to do like one or two more. Keep sending them to me. You can email them to me if you want, to a Bergman IRA Financial. There's a lot. There's probably 20 more or so. I'm not going to be able to get to them, but I will do my best to answer them. I'll maybe do a Q&A. I did a Q&A for my last webinar on my last self-directed retirement on partnering with yourself. So maybe I'll do a Q&A webinar maybe in a week or so or 2 weeks. If I keep getting more questions, there's a lot there. Let me do one or two more. They're all good ones. I don't want to pick and choose because they're all really good. I'm happy people are actually paying attention and put you guys to sleep yet. What about buying a lease for Burger King? Net lease. Again, if you're getting rental income, there's no leverage, you're going to be fine. Just rental income. How do you do the math to figure out if it's worth to acquire real estate that generates short-term rental income, non-recourse loan, if you can defer that income in a self-employed 401k? Whoa. So yeah, I mean, you got to run the numbers. If it's interest, again, if it's a non-recourse loan in a 401k, you have no UBTI, right? Because there's an exemption under 514c9, so that's good. I think using a 401k always helps, right? It's an IRA and 401k, you'll always get tax deferred treatment. 401k also lets you put away more money, so that's good too if you're self-employed. Plus, there's an exemption under 514c9 for real estate, even better. I don't think you lose anything. So that's kind of the calculation I would look at. My husband and I are clearly not subject to UBTI. Great. However, do we still need to file a Form 1065-8825 Schedule K? I don't know. If you own an LLC with 2 or more members, yeah, you got to file 1065 even though no taxes due. Other than that, the custodian will file the 5498. But again, this webinar is really about UBTI, so I'm going to kind of focus on the UBTI. What if we have oil and gas and didn't realize it was going to have UBTI? What are losses from years past? So right, if you have losses from year past, you got NOLs, that's good. That will eat up some of your profit. You're going to have to talk to the promoter and try to get that information. You can do it now if there's UBTI, that's fine. Okay, this is got a lot more. Maybe this is the last one. I don't think most people own both self-directed Solo K and IRA. It's hard to understand when he goes back and forth. I'm unclear now as when we started. Well, that's not good. Will there be a written format? No, I'm not going to be able to do this in written format. You can watch it over again as many times as you want. You can also contact me, and I'm happy to go through any questions you have in detail. That's certainly something I can do for my clients. I'm sorry if I confused you. But let me just summarize this in 1 minute, okay? IRAs and 401ks, they all have the same rules, prohibited transactions, except life insurance, right? If you own a 401k, you can buy life insurance. If you own an IRA, you can't. Otherwise, same prohibited transaction rules. Now, UBTI rules. Same UBTI rules except real estate acquisition. If you use acquisition indebtedness, a non-recourse loan to buy real estate in an IRA, you're subject to UBTI. If you do it in a 401k, no UBTI. That's the only difference. Every other instance is the same. So active trader business in an IRA or 401k, pass-through entity, UBTI. Doesn't matter if you use a self-directed IRA or you use a 401k. The only difference is if you use a non-recourse loan to buy real estate and you do it in an IRA in a pass-through entity, you have UBTI. If you do it in a 401k, no UBTI. Okay. Other than that, there's no distinction. That is the only distinction in UBTI world is real estate acquisition indebtedness for real estate using an LLC or partnership. If you did it in a 401k, you have no UBTI as per 514C9. If you do it in an IRA, you do have UBTI. Otherwise, it's the same rules. Prohibited transaction rules, IRAs and 401ks are the same other than life insurance. Okay. I'm sorry if I wasn't more clear. I'll do better next time. But those are really the only distinctions. If you use real estate acquisition indebtedness in an IRA, you'll have UBTI, assuming you didn't do a C Corp blocker. In a 401k, you will not have UBTI. Okay. Otherwise, it's the same UBTI rules. If you invest in an active trader business through a LLC and you do it in an IRA or 401k, UBTI. If you buy margin or buy stock, IRA, 401k, same UBTI application. If you do it, if you buy real estate, non-recourse loan, and a 401k, no UBTI. If you use an IRA, you did, and you will have UBTI. Only distinction, so I'm sorry. I hope that's clear. Okay, last one. But buying and selling real estate with debt. I didn't know that I fell under UBTI. Can I be fined by IRS? Yeah, I mean, you should file a 990T, and you should go back and file for what you haven't done. And I'm assuming you will be able to come to some arrangement with the IRS because they generally understand this stuff's really complicated, and they generally make arrangements to help you. They may just have, they may probably not going to penalize you, probably just charge you interest on any of the tax due. But something you should talk to a tax advisor about and see how you want to address that. Let's actually try to end on something more positive. I loan to flippers, hold mortgage and personal and business guarantee. Does UBTI affect me? No, because all you're doing is getting interest, so you're good. That's a very clean investment. You lend money to real estate investors, you get interest back, you're good. So let's end on that. It's a good question. Again, this is going to be taped, it's recorded, it's videoed, so you'll get to look at me and see my face. Or if you don't want to see my face, you could simply just listen to me, which you're probably better off not seeing my face for an hour. And otherwise, I hope this was helpful and interesting and insightful and meaningful. If you have more questions, you can email me. There's a whole lot more I didn't get to, a lot more actually. So if you think it's beneficial to do another Q&A on this topic, I will do it in a week or 2 weeks, I promise. If you have other ideas for topics, email me. Subscribe to our YouTube channel. You'll get notified when there's videos. We're becoming a little bit more, I think, education focused. We're going to be sending out weekly newsletters on different topics to all our clients. All of you that have been registered and are listening are clients that are part of our annual compliance service, which most of our clients do, thankfully. It's well worth it. I wish the clients that didn't or don't see the need for it, they're the ones that usually get into trouble because they're not willing to spend a few $100 to get educational content, access to webinars, podcasts, videos throughout 12 months. And unfortunately, those are the ones that run into problems. So kudos to you guys for taking an active role and trying to make sure you stay in compliance and maximize the benefits of self-directed retirement investments. Adam Bergman, IRA Financial. Again, if you have questions, email me at Bergman, IRA Financial, or subscribe to our YouTube channel. You can follow us on Instagram, Facebook, Twitter at IRAFG. Thanks for listening, attending, watching, and until next time, thank you.